Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar index returned to the lows of September last year after a brief surge at the start of the week. The rebound of the U.S. currency was only sufficient to close the gap created by the announcement of tariffs. The technical picture since the beginning of the month indicates that the dollar index is entering a new phase of active decline after the rebound at the end of March. Potential downside targets are in the range of 99 to 100. The lower boundary of this zone aligns with the 161.8% level of the initial decline, while the upper boundary represents the psychologically significant round level that previously halted the USD decline in September last year. On the weekly charts, the bearish sentiment appears even stronger. The USD index has fallen below the 200-week moving average, which has acted as robust support over the past 3 years. This could signal a reversal of a multi-year trend. Similar signals 5 years ago led to the dollar losing 7% before reaching its lowest point, while in 2017 the decline was 5%. This week saw one of the most epic reversals in the U.S. indices. On Wednesday, the S&P 500 added about 9.5% for the day, posting the third largest gain in its 75-year history and rebounding 9/10 of the decline caused by stiff tariffs. Market sentiment is still just 16, an extreme fear zone. However, this is a sharp rise out of the single-digit area, 3 to 4 since the beginning of the week. Historically, such bounces in the sentiment index have served as an important signal of a return to growth, at least for the coming days. Countering the absolute positivity is the example of 2022, when the fear and greed index hit a low in May and the S&P 500 hit a low in October. At that time, there were several waves of declines, each leading to lower lows. A strong buy signal over the long term requires a change in fundamentals. These could be optimistic agreements on tariffs and the recovery of business optimism. Technically, the picture is now on the side of optimists. On weekly timeframes, the S&P 500 has bounced off its 200-week moving average, an important support line of the last 10 years. The RSI index on this chart has also rebounded from its lowest point since 2020. However, it's important to remember that market recoveries typically take 2 to 3 times longer than declines. For example, in 2018, it took 22 weeks of growth to recover from a 9-week decline. The current 7-week downturn may take 17 to 22 weeks to recover. Gold is living a life of its own, posting strong gains of 3% on Wednesday and over 2% on Thursday. Even as stocks have recently been moving in opposite directions, gold appears to be moving independently, and the latest corrective pullback from 3 to 7 April has encouraged buyers, bringing the price back to the 50-day moving average. Gold's closing the week at all-time highs triggers a pattern of expanding gains, with the potential to strengthen above $3,500. Silver took a harsher blow. It is still struggling to recover from the 18% decline to $28.3 after touching the multi-year pivot zone near $35 late last month. Further strengthening of gold could trigger a renewed assault on the resistance that has held the price down for the past 13 years. A success, meaning a consolidation above $35, could prove to be a prelude to a spectacular rally all the way to $50. The cryptocurrency market cap has stabilized near a key level since the start of the week and went up steadily on the back of tariff news, following the rise in equities. However, the spurt was half that of equities. Total capitalization reached $2.60 trillion, pushing back from support near $2.3 trillion, the level from which the rally began late last year. So far, the rise has been met with caution as capitalization has yet to cross its 200-day moving average, which is pointing upwards and approaching $2.96 trillion. Bitcoin held firmly below $75,000 support at the beginning of the week. The recent growth spurt has lifted the price above $80,000, which can be considered a comfort zone. However, the first cryptocurrency approached the upper boundary of the downtrend, and the main test of the 2-month trend is just beginning. Ethereum is showing weakness relative to the market, dipping below $1,400 at the lows of the week and bouncing back later to $1,600. This bounced off the lower boundary of the descending corridor, and the upper boundary was near $1,900. This level will be an important point to watch for a possible upside development. In the week ahead, trade tariffs are set to dominate global attention around the clock, though key scheduled events will still remain important. On Wednesday, the U.S. retail sales data is worth watching. The last 3 reports have come in significantly below expectations, but talk of tariffs this time may encourage consumers to shop more aggressively. This is usually good news for the markets, but in the current situation, it is more of a reminder of the changes in the economy. Also on Wednesday, the Bank of Canada will decide on its key rate. It has been falling for the last 7 meetings, and the impact of the rates could lead to a continuation of this series of easing, softening the economic harm. The ECB, which began making rate decisions last June, will present its decision on Thursday. Uncertainty remains high, but the likelihood of further rate cuts prevails. Inflationary trends now allow the central bank to ease the blow before the negative effects of tariffs strike. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.